Hey there, investors. Today we're diving into something that might surprise you. While most banks are struggling with falling interest rates, OCBC has managed to pull off quite a feat in their Q1 results. They've actually beaten analyst forecasts despite the challenges. If you've been worried about your bank investments lately, you're not alone. With interest rates dropping and economic uncertainty everywhere, it's natural to question if banking stocks are still worth holding. But what if I told you that OCBC's strategy might be the perfect blueprint for navigating these choppy waters? Let's start with the headline numbers. OCBC reported a net profit of $1.8 billion for Q1 2025. This is 5% lower than the same period last year, but 12% higher than the previous quarter. And they beat analyst forecasts despite that year-on-year decline. Breaking it down further, net profit was $1.88 billion. Down 5% year-on-year, but up 12% quarter-on-quarter. Net interest income declined by 4% to $2.35 billion due to narrower margins. While average assets grew by 3%, this was more than offset by a narrower net interest margin and the effect of a shorter quarter. What really stands out here is how OCBC managed to offset the decline in interest income through growth in other areas. Non-interest income was up 10% to $1.31 billion on stronger fees, trading and insurance income, while operating expenses decreased by 9% quarter-on-quarter to $1.42 billion. Like other Singapore banks, OCBC is feeling the squeeze from falling interest rates. The Singapore overnight rate average dropped by 51 basis points to 2.56% during the first 3 months of 2025. This directly impacts how much banks can earn from their loans. OCBC saw a steeper 23 basis point year-on-year compression in its net interest margin to 2.04%, down from 2.27% a year earlier. The decline was largely due to loan yields tightening at a faster pace than deposit costs. Despite these challenges, OCBC's loan book grew by 7% year-on-year as of March 31st, 2025, reaching $322 billion. That's pretty solid growth and aligns with the broader Singapore banking sector. Corporate, SME, and consumer private banking comprise 56%, 9%, and 35% of the loan book, respectively. Asset quality remains stable for now, with OCBC's non-performing loan ratio at 0.9% in Q1 2025, down from 1% a year ago. However, the bank is being cautious. They increased their total allowances by 25% to $212 million, comprising $94 million for impaired assets and $118 million for non-impaired assets. The NPA coverage ratio rose year-on-year to 162% from higher allowances set aside and a decline in NPAs. One of the most positive aspects of OCBC's results was the growth in non-interest income, particularly fees from wealth management. Wealth management fees rose 9% quarter-on-quarter, with increased customer activities from a higher AUM base. Banking wealth management assets under management reached $306 billion. Trading income also showed impressive growth, rising to $396 million, driven by both customer flow and non-customer flow income. This is crucial because it helps offset the pressure on interest income. When we look at Singapore's banking trio, we see some interesting patterns. DBS leads in absolute profit with $2.9 billion, down 2% year-on-year, but OCBC shows strong resilience in fee income growth. UOB maintains stable profits at $1.49 billion. OCBC's strategy can be summed up in 2 words: integration and balance. The bank is pursuing a one-group strategy that streamlines its consumer, wealth, and insurance arms across ASEAN and Greater China. A key advantage for OCBC is its ownership of Great Eastern and Bank of Singapore. This gives them multiple income streams and cross-selling opportunities. OCBC is often described as more conservative in risk-taking compared to DBS and UOB. In uncertain times like these, that conservative approach might be a strength rather than a weakness. For income-focused investors, OCBC offers an attractive dividend yield of 5.07% with a sustainable 50% payout policy. Singapore banks in general are offering high dividend yields for 2025, making them appealing in a portfolio focused on passive income. Several risk factors could impact OCBC in the coming months. First, asset quality deterioration. Analysts anticipate that asset quality could worsen in the second half of 2025, primarily due to global trade slowdowns. Second, U.S. tariffs impact. OCBC's Group Chief Financial Officer stated that tariffs could have a first-order impact on 3% of OCBC's loan book. Third, Singapore's economic slowdown. Singapore's 2025 economic growth forecasts have been revised lower to 0.2%, down from the previous 1.3%. Looking ahead, OCBC CEO Helen Wong noted that the heightened uncertainties brought about by the shifts in trade policies and geopolitical risks are expected to have a dampening effect on overall economic growth in the region. Despite these concerns, OCBC reaffirmed all of its financial objectives for 2025, including a net interest margin of around 2% and credit costs projected between 20 to 25 basis points. Weighing all factors, I see OCBC as a solid long-term investment, particularly for those seeking a balance of income and growth with moderate risk. The bank's ability to grow non-interest income, maintain loan growth, and take a prudent approach to potential challenges demonstrates good management. For those already holding OCBC shares, I recommend holding through this period of uncertainty. For those looking to enter, consider a dollar-cost averaging approach over the next few months to manage the risk of further short-term declines. Remember, banking stocks typically move in cycles, and the current pressure on margins won't last forever. When interest rates eventually stabilize, OCBC will be well-positioned with its diversified income streams and strong regional presence. So there you have it. OCBC's Q1 2025 results show a bank that's navigating challenging waters with skill and foresight. Their diversified income streams, solid loan growth, and prudent risk management make them well-positioned to weather current economic uncertainties. The 5.07% dividend yield makes OCBC particularly attractive for income investors, while their conservative approach provides some peace of mind during volatile times. Remember, investing is a marathon, not a sprint. Banks like OCBC have been around for generations and have weathered many economic storms. Their current strategy suggests they're well prepared for whatever comes next. If you found this analysis helpful, please hit that like button and subscribe to the channel for more investing insights. Drop a comment below with your thoughts on Singapore banks. Are you buying, holding, or selling in the current environment? Until next time, this is Iggy from the Investing Iguana, helping you navigate the financial jungle one step at a time.